Good afternoon, ladies and gentlemen. I hope you enjoyed your lunch, and welcome to this discussion this morning that's focusing on the outlook for the global economy. I've got four esteemed panelists here on stage, and I think I would give them each the opportunity to introduce themselves and just quickly tell us, how your business feeds into the global economy.
Yep, as per the previous panel, pre-lunch but now post-lunch, I'm Hwindingwi. I'm Chairman and CEO of GMEX Group and 013. And from an economic standpoint, we're dealing a lot with both sovereign governments and private asset stakeholders in mining, carbon assets, and other areas in terms of digitizing and monetizing those assets. So effectively matching capital with the asset pools that exist today.
Hi everyone, I'm Kalnisha Singh. I'm a development economist with KD Strategies. We are looking at supporting industrial and infrastructure expansion across the continent and work specifically at the intersection of economic development and sustainable communities.
Good afternoon, everyone. My name is Zaynab Hoosen. I'm a senior Africa analyst at Pangea Risk. Pangea Risk is a specialist risk advisory company providing country risk services for companies operating in emerging markets.
So my name is Dr. Rutendo Hwindingwi. As previously introduced, I'm a CEO and founder of Tribe Africa Advisory, a niche advisory firm focusing on business development and working with leaders in terms of especially multinational excos and boards, how to navigate the business landscape in Africa.
Thank you very much, ladies and gentlemen. And diving right into the global economic outlook, I think, from an S&P Global Market Intelligence view, we were, quite surprised. Well, I wouldn't say surprised, but we were positively surprised by the resilience of the global economy during the past year. At the start of the year, I think most of us were very uncertain about how this year is going to unfold with the US tariffs and the geopolitical changes. And up to now, the global economy has actually performed relatively well. Inflation has been contained. We're expecting lower rates in the US economy and countries like South Africa following suit. Zaynab, why did that happen? Why the upward surprise in global economic activity during the past year?
Thanks, Thea. Yeah, so I think that when the tariff announcement was made, it was a shock, and I think that that everyone sort of hopped on the same narrative that things were going to turn out a lot worse. But the world economy has shown a reasonable amount of resilience, and that comes from countries being willing to negotiate with each other, still pushing through trade despite the challenging situation. And they've also shown a willingness to engage each other, and I think that there was this fear about isolation. But it shows that the world economy is so interconnected that even though this change had happened on the US side, there's still a number of ways to channel economic activity, and that's what has pushed us through.
For you.
Me.
Obviously, China is one of the biggest consumers of global commodities. And we spoke a lot about it yesterday, about critical minerals and how they feed into the global supply chain. But this is an economy that's going through some structural issues themselves. What is your view on China for the coming year and next year? And do you think, this economy will be able to rebalance and the demand for commodities will be upheld?
Yeah, it's an interesting question, and we'll also put that into global context. So, as I was mentioning on the previous panel, I came back from COP13 Belém recently, and on the sustainability kind of ESG carbon market side, China sent 300 people there. So where the US kind of retrenched, China's seeing an opportunity not just kind of in its position, and previous panels have spoken about this, in its position with rare earths, what it's doing on the solar value chain and everything else in terms of production. It's been active in Africa for a long time, but it's also now seeing another opportunity in sort of the green financing side, and also even on carbon credits, and even internationalizing its own opportunities domestically. So, for example, I'll be in Shanghai next month, and whilst it's domestically focused, there's a green finance summit there, and that's for the first time in a long time. So I think China's looking to fill the void with the US there, but this also creates opportunity because on the other hand, I was in Riyadh recently, just before Brazil, so I've been flying around quite a bit. I'll have to carbon offset soon as well. But the Saudis are very, very interesting because everyone thinks, okay, they've got a lot of money at PIF level, the sovereign fund level, and they're investing out, but they also need a substantial amount of investment in, not just for projects like NEOM, but whether it's for green infrastructure, green energy projects, because let's put it into perspective, and this will put it into good geopolitical context as well. The Crown Prince, for example, is in the US at the moment, and there's large deals being signed for large AI development and Saudi data centers that can be constructed, and NVIDIA and others involved. But actually, what do data centers and AI need? AI needs data centers need energy, data centers need servers need critical minerals, and they need rare earth elements as well. So I think the whole circularity aspect comes right back to home with what we're doing in Africa as well, because there's a huge opportunity for us with the US becoming active, even though they're earlier stage, and also harnessing kind of what the demand in China as well, and also looking at where we can produce ourselves too.
Yeah, absolutely. Dr. Rutendo, coming to you, I mean, the US has been mentioned in this answer. And I think, again, do you think Africa has become much more important for the US in this critical mineral supply chain demands, as we hear from AI? What approach is the US going to take in approaching countries in trade deals, in securing commodity offtake? Is it a transactional view? And how do you see, how do they approach Africa with all the debt all the aid that has been suspended?
So just picking up from what my colleague says, definitely South Africa is absolutely critical for US growth. I mean, he was talking about the raw materials going to China. China, 55% of its transition metals or minerals come from Africa in terms of it producing what it has to produce. America is wanting to be less dependent on China because what happens is, remember, China trades with the US. There's a 80% surplus of trade between US and China, which is about $400 billion US. All that not Mr. Trump wants to do, he wants to turn it on its head. He wants to be the one having the surplus. But for him to have the surplus, that means he has to produce. For he has to produce, he has to get from Africa. So comes into play the infrastructure they're putting in Africa to export minerals back to the US. A good example is the Lobito corridor that runs from Lobito in Angola all the way to the DRC. Why have they built that? They've built that to compete with the Belt Road Initiative by China, which is doing the exact same thing. What are they wanting out? They're wanting those rare minerals. They want them cheap. So it is a transaction. The question is who's benefited the most from that transaction. At the moment, obviously, South Africa or Africa is at the bottom end. So I think the short answer to that, Thea, is that definitely Africa is at the center of America's strategy with regards to going to the next level. The question is, are we valuing what we're giving to the US at the right value? Because that's where the challenge is. But let's not take it for granted. America needs Africa in order to grow to the next level, especially from a commodities and a raw materials perspective.
Kalishna, I think moving to you, and I think Africa's growth has been quite resilient despite, more global fragilities in Asia and Brazil. Developing economies' growth outlook for next year is amongst the highest. And Africa is, of course, a lot of those developing economies. And I want to really urge the panelists to think about this question now. How do we sustain this growth, and how do we benefit from this critical mineral, demand that's coming up globally, and the opportunities this will give to the continent? And maybe also, is this a time for a new growth model for Africa? So, from your perspective, being a consultant and really an expert in supply chain development, diversification, how can we leverage this opportunity of critical minerals and other commodities?
So, it's interesting because from a sort of macroeconomic lens and an overarching view, everything is sort of hunky-dory, positive, better than we ever expected. But what's happening on the ground right now in sort of real time is a very disjointed reality of projects being invested in independently of the sort of macroeconomic conditions. And what that means is that from an economic perspective, while we sort of rely on aggregation to measure trends and outlook, what we're seeing is sort of independent silos of excellence rather than a consolidated view of systemic progress, right? So as opposed to the dots being connected to form a picture, the dots are remaining independent of each other. And that's the sort of biggest risk that we face, I think, as a continent, because the ingredients are there for sort of systemic change, for a new growth path, for a new growth trajectory, especially now as we're expecting that sort of traditional mining value chains are slowing down. We expect a slowdown over the next 15 years as sort of the mainstream ore belts dry up, figuratively. But parallel to those ore belts is where we are expecting to find the critical rare earth elements and other critical minerals, and that exploration is currently happening in kind of real time, but in a fragmented way. We are seeing increased capital flows into exploration and prospecting activity, but very similar to sort of those capital flows are landing in similar ways that it did during the 1800s, during the gold rush in the continent, and then again in the early 2000s with the sort of Chinese expansion in the mining industry. So we seem to be playing by the same playbook that we have for the last 20 years. And what that means for the African continent is increased, extraction-based economies, which it hasn't been a recipe for success for us, those of us that live here and work here, right? So it's a sort of cautionary outlook that we're taking from the home ground.
Just before coming to you, here, Andre, Zaynab, are we seeing, we just heard that there's new capital inflows into the continent, although fragmented. Do we see new investment partners shift away from the classical partners, which was dominated by China?
Yes, Thea, we are seeing that. Now in recent years, I would say that the Gulf partners are playing an increasingly dominant role, specifically in Africa. So not only in minerals extraction, but in logistics as well. So it's now showing that there's an understanding that apart from extracting the minerals, there's also opportunities in investing in the logistics that gets the minerals out. So we've got Lobito Corridor, which is backed by the US and the EU. But then from the UAE, we've got DP World, which has been investing in ports in East Africa and actually all over the continent. So they are coming in and really trying to improve the efficiency of how these ports operate. Earlier on, it was mentioned that Durban port is ranked the third lowest, and our ports in the rest of the continent also really struggle with congestion and things like that. So upgrading this infrastructure is really where the UAE investors have played an important role. We also saw that earlier this year, a company from the UAE acquired a majority stake in Mopani copper mine in Zambia, which is an asset that's really been sort of dormant since the state took over. So there is now a diversification of partners for African countries where there's choice. It's not necessarily just, yes, China is still quite dominant in those sectors, but we are slowly seeing that change. And it will take some time, but I do think that it's a healthy diversification that we are witnessing on the continent.
Is it time for a new growth model on the continent?
Yeah, it's interesting. I mean, just to pick up on some of the comments, because I spent a lot of time in the Middle East, whether it's Qatar, Riyadh recently, the UAE, where I'll be in a few days. It is interesting because obviously markets like Saudi, as I mentioned, have an inbound investment strategy as well. But I think what COVID really highlighted to a lot of these countries, because the shelves were empty, was there was a real need for kind of food security, water security, and increasingly, an energy security need. And I think that's playing to our strengths in Africa because, with some of the examples mentioned, but also Qatar Investment Authority and Qatar more broadly have signed strategic partnerships in Mozambique and other countries as well. The Middle Eastern countries see it as a huge development opportunity. It's a great opportunity for us because they're new pools of capital, and they might not necessarily come with some of the shackles, so to speak, that other forms of capital come with as well. And so that's opening up competition for the likes of China. The US coming in as well is a good thing, and we should really be dividing and ruling the other way around, and trying to harness kind of the best offers for us. Now, going back to your question about new pools of capital, some of these things are happening. Everyone talks about rare earth elements. They exist in many forms in many places, but it's the extraction that is challenging. I can't talk about it yet, but it's not public. But there's things happening here. There's a $2 billion project on the ground here that we're involved in with the issuer, and that will be tokenized, but not just the ability for the assets that are valued and tested, but the IP being brought in to be able to extract as well, because one without the other isn't really useful. We've got to look at this holistically, as well as the logistics side, which we speak about. Now that's gonna lead to around $2 billion worth of investment into South Africa with the right structures, and this is happening right now. There's other projects as well here. In fact, I've never been so excited about the opportunities here, notwithstanding, there's ease of business issues everywhere. We get those in the Western world as well, and there's ways to kind of navigate those. But I'm quite excited about some of the opportunities here in South Africa as well in that regard.
Dr. Rutendo, going back to you, so we hear interest from a lot of new partners, maybe having more pragmatic approach to investment. Do you think, how can the US position itself to not lose this opportunity? And also, do you think the Africa Continental Free Trade Agreement plays into this decision by the US to participate in the investment rebound expected on the continent?
So it's actually interesting because yesterday I was at a US chamber event with a delegation from the US, minus Donald Trump because he didn't come, which was, as we all know. But the Secretary General of the Africa Continental Free Trade Agreement, Wamkele, was there. And the reality is this, I was talking to my colleagues saying that you need to separate the politics from the economics. The politics right now tell you that in the next 3 years, the current political administration of the US won't change. That's the reality. Post 3 years, it will change in one way or the other. But from an economic perspective, the structures that are there, in terms of trade between Africa and the US right now, that structure and that framework has grown over the last 20 years. It won't take 2 years or 3 years to change. So there's another reality we need to change, except the Africa Continental Free Trade Agreement is there to say, let's industrialize and create beneficiation on the continent so that whatever we export has more value, which benefits the continent, number one. Number two, what people take for granted, of the 190 billion, plus or minus $200 billion of intercontinental trade that happens on the African continent, 40% of it comes from Southern Africa. 20% of it relies on South Africa. After South Africa, I think it's probably your Nigerias and your Egypts. They're probably on 5%. Why am I highlighting this? South Africa, Sub-Saharan Africa, the wealth of intercontinental trade infrastructure facility is in Sub-Saharan Africa, more in Southern Africa. That's the reality. Why is this important? For the US to strengthen and develop itself on the African continent, for its foreign policy from both an economic and political perspective to grow, it has to leverage off Southern Africa, South Africa. So that's the answer to your question, is that you cannot put South Africa, Southern Africa, irrespective of politics. A case in example, on Saturday, Walmart, one of the biggest retailers in the US, is opening up in South Africa. Irrespective of the politics, Walmart is opening up in Clearwater. Hopefully, I won't tell my wife, others she'll go shopping and I'll be broke. But the point is, there's the politics, there's the economics. So my suggestion, when I speak to my US colleagues, is to realize, guys, there's the politics, it is what it is. You have to work through diplomacy. But from an economic perspective, we're too big a continent to be put on the sidelines and be underestimated in terms of the value we contribute, especially when you started looking at regional recs in terms of what we bring to and that's where the heartbeat of the future is. And I'll end with this. Everybody's talking about AI technology, et cetera, et cetera. Everybody's talking about a growing population in the world. To power AI, you're going to have to need infrastructure, which is the raw materials. You're going to need a lot of power and energy, which is raw materials from Africa. By 2050, 50% of the world's population will be in Africa, but everybody else would have grown in terms of quantities. People need food. 65% of the most arable land in the world is in Africa. We are positioned to supply and equip the future of the world. It's just we have to get our house in order.
Commissioner, how do we make sure that we, through benefication for value addition, we heard a lot about constraints, electricity constraints, infrastructure constraints, the opportunities under the Africa Continental Free Trade Agreement. How do we make sure that we do the right things, and what are the right things to achieve diversification, benefication?
So that's a very, very loaded question, right? We need to get our house in order and we need to start working together, really. I think in terms of the recipe for sort of, for local beneficiation on the African continent, we have the sort of components of everything that we need in order to sort of kickstart local industrial development and enable benefication, right? The challenge that we have from a free trade or from the African Continental Free Trade Agreement perspective is that at the same time as we're trying to develop a sort of continental enablement in terms of trade, we're also trying to develop hyperlocal industries within countries. So there's sort of this dichotomy in our intention, which is kind of playing out in real life. So as much as we're trying to, create this continental view and leverage our strengths on paper, in practice and in regulation at a hyperlocal level, we're sort of very segmented in how we're trying to diversify supply chains into big infrastructure projects, into new exploration and prospecting rights, and all of these things. And that's sort of the cleaning up that we need to do internally on the continent. But in terms of, Africa's ready on paper, where we have all the components we need, we have the trade agreements that we need, we have the partners, we have the capital flow. It's just now about sort of putting the recipe together and beating it up a little bit, I think.
I was wondering if there's any questions from the audience for these panelists. Sorry, I can't see very well, so if...
We need sunglasses.
Yeah. Is there any questions from the audience? No? Also, how much time do we have left? 1:05, okay, 15. So no questions from the audience. Okay. So then for each panelist, going into next year, are you excited about Africa's prospects? What do you think is going to drive the outlook for Africa next year, 2026? Maybe start on my left.
Yeah, I'm extremely excited. I mean, there's huge opportunity here. I mean, just giving some examples. So I spend a lot of time in Kenya as well, for example. We've spoken about examples elsewhere. Where we talk about value add, there are some very good points here. We've got to start to not just export raw materials, but look at the value add. So an example being, there's a Kaptagat forest program in the Great Rift Valley, outside Eldoret in Kenya. It's set up really well, supported by government, but independently, like 28,000 farming families, a large expanse of hectares. But really, some of the things that have been done there is, okay, how do we think differently? Because that started with looking at, okay, carbon credits and high-value carbon credits under something called Article 6.2. But then when you looked at it, we then said, okay, renewable energy, and there's opportunities like that on the land, and there's a number of agreements that have been signed there. But actually, a lot of the value there was, well, let's really look at, relative to the soil and what grows there, high-value crops, rather than preserve trees. Let's see how we can produce output. So, what they're doing is they're looking at tea, coffee, macadamia, avocado, and of course, rather than look at kind of lower value crops, that's kind of increasing the income from that kind of output, and then carbon credits increase the ROI by about 20% as well, and that's all without actually processing any of that and producing it locally or any of the manufacturing. So there are simple steps that could transition us by looking at how we optimize the resource usage that we have relative to kind of the land-based assets that we have, and they're huge. Which actually it was quite saddening to see when I was in Harare not long ago, and there everything was very sophisticated in terms of what you grew, where you grazed on the land, electricity usage, the cooperatives, even a Barclays Bank in there, 3 cooperatives. And through mismanagement and breaking that up, it was all spoiled, right? And it's an opportunity, but in its time, that model kind of really worked. Now we've got even more opportunity because, we speak about new forms of capital. Over the next 18 months, as I was mentioning on the previous panel, if we have investable assets, and we're not just talking mining assets, but agro assets as well, energy assets, and there's numerous projects, there's billions of dollars worth of capital that can be harnessed into them, and it's ready and available right now.
Maybe just a follow-up question. How do you see the risk mitigation for climate change on agriculture? And I agree with you. I think agriculture, food is a big opportunity, but how do you think countries take that challenge on?
Yeah, it's a great question, and then it's really interesting. We got into commodities through looking at carbon credits, carbon offsets, and some of those types of projects, and everything from those projects and others. And when I looked at it, everyone thought about the carbon market as a market, but there's no real pricing. This piece of air versus that piece of air being valuable and not so valuable. There was no real guidance around it. You guys on the commodity insight side with S&P have done a huge amount of work, as with your team in Belém, and it's impressive. Kind of, the prices for those aren't on Bloomberg. They're with these guys. Some free advertising. But what I mean is, it's an incredible amount of data that's available to harness. But really, the opportunities here resolve around something that's producing. Because if you're just preserving a forest, sometimes the local communities, if you look at Kaptagat, rely on the forest for firewood, rely on the forest where they chop down the wood and they're selling that for fuel to others as well. You've got to replace those incomes, because otherwise it just doesn't work, And so bringing in industry, and this isn't just, there's a macro level outlook, and we're looking at this here, but that's got to then translate into micro level. Some of the previous panels spoke about the lack of lending. So some of this new forms of capital is also unlocking that and forward financing some of these opportunities. So being involved in agri in Africa when we were looking at electronic warehouse receipts since 2017, it was incredibly difficult before, but for the first time from the beginning of the year, and some of it was because of geopolitical shifts and, what I mentioned with US aid dissipating. We're starting to see genuine opportunity and a will, and I think, we've reached the conclusion, if you can combine what you're doing on the carbon offset side with real output, there's a real market for it as well, and you're turning ESG from a compliance cost into a revenue opportunity.
Interesting. Excited about Africa next year, and why?
So, I take a wider view, so I'm excited about Africa, I think, over the next 10 years, but particularly next year, because I think what's happening and what we're seeing is the sort of, we're moving into the turn to sort of enable a turning point on the continent. There's lots of sort of transition management that needs to happen. We're seeing the downsizing of legacy mines, but at the same time, reimagining of what the mining sector could look like around the sort of new exploration and prospecting activities. We are seeing increased capital flows in pools and interesting capital, so lots of alternative capital products. And we also see, like in South Africa, that there's a grand evolution of the sort of commercial banking market that is rising up to meet the sort of new kind of capital needs in the Southern African region. So I think that there's an increased, there's also an interesting political intersection currently at play, right? So we're seeing a political transitionary ecosystem in the Southern African regions, but there's a growing sort of awareness around the required political restructuring for the rest of the continent that's required to sort of enable greater economic participation and more valuable economic participation from African countries. So I think the outlook is generally positive. I think it's probably better than we've seen in decades. And it's very, very exciting.
Zaynab?
Thank you. So I think over the next year, I'll build on what Kalnisha said from a political perspective, because that's what I spend most of my time doing. And it's also in Africa, this wave of change that is causing some short-term challenges, I would say, in terms of unrest. But at the same time, it's telling of what the populations are demanding of their governments. Populations are becoming more assertive about being included in economic activity, and I think that is one of the major demands is like how do we harness this youth? How do we harness this growing population? We often talk about Africa's demographic dividend in the next 30 years, but how are governments harnessing it, and how are they setting up the policy infrastructure now in order to take advantage of that later in the context of the global economy and in the context of the commodities that the country has. So we talked a bit about local beneficiation, but I think there's also real value in building policies that can bring everyone on board. And the fact that we are now seeing populations demanding that more, governments sort of have to become more responsive. So the long-ruling governments in Southern Africa, but also in the rest of the continent, they are now realizing that they need to set up policy frameworks and need to set up state institutions that are stronger and that can cater for this growing population. We also see that there's a push for anti-corruption with these protests. So an earlier panel mentioned that corruption is one of the major challenges that the private sector faces. So building the stronger state institutions and also setting up the policy infrastructure for it can facilitate this 10-year positive outlook. So I think what's exciting is that the foundations are being set and the changes are slowly but surely materializing.
Doctor?
I think from my side, two key things. One is diversification of economies, and the other one is VC tech startups. And I'll just drill down into those very quickly. Diversification, the more the African economies diversify and leverage off in terms of opportunities, the better. Example, Angola traditional and oil-based economy has just had its biggest investment in a data warehousing company. The biggest, it's an American asset company that's invested in there. They launched it about 2 or 3 months ago. Botswana, because of the lab diamonds and the increase of that, we've seen the impact of diamonds and the value of the economy. They are now re-looking at the economy and saying what other opportunities are there, and it's forcing them to diversify. You go to Ethiopia, they've just received a $10 billion investment from America to build a new airport outside Addis Ababa. Why am I highlighting this? The more we diversify as economies, the bigger we can position ourselves as Africa to go to the next level. Coming to tech startups, VC funding, last year alone, globally, $350 billion was invested by VCs, venture capitalists globally, in terms of tech startups because they stimulate the economies to the next level. Of that $350 billion plus or minus, 180 was in the US. Asia and Europe probably shared plus or minus $100. Africa, of that $350 billion, only received $3.2 billion. We received a drop in the ocean. You can look at that and say, gosh, it's a glass half empty. I look at it, it's a glass half full. Why? If we position ourselves with the right capital structures, with the right politics, with the right infrastructure, et cetera, there's $350 billion of VC money out there that we can bring to the continent to take it to the next level. So for me, those two components, I would ring fence and say that's where, and it's already happening. Obviously, fintech playing a leading role, agri-tech, even in the mining space, it's already happening. But if we can accelerate that with the right governance structures, leadership, et cetera, we'll go to the next level.
And Dr. to find maybe last round of questions. Biggest risk for Africa going into next year?
Ooh la la. Do you know what? I think it differs from country to country. I think the challenge we have in Africa is that the reality is we're 54 countries. And when you try and homogenize solutions for Africa, in terms of saying we're one continent, 54, let's come up with one solution, it will fail. The macroeconomics, the politics of a Zimbabwe compared to a South Africa, compared to an Egypt is different. So the biggest risk, to be honest with you, is not in terms of what the world perceives us to be, is how we actually accept that we are different, but how do we leverage off our unique capabilities and take things to the next level. I mean, I'll highlight this. 50% of Africa's GDP is in 5 countries. We're 54, but 50% of our wealth is in 5 countries. So when you think about influence in a continent, don't waste time trying to influence 54 countries. Identify the 5 big boys: Nigeria, South Africa, Egypt, Algeria, and Ethiopia, those 5. And you say, okay, how do I influence these 5 big boys to influence the others? So I think from a heterogeneous perspective, don't homogenize Africa, heterogenize it and accept that we're different, but what are the unique capabilities? And that's what AFCFTA to a certain extent is trying to achieve. So if we mitigate against that risk, I think that's a big step.
Zaynab, biggest risks for next year?
I would say the biggest risk is resistance to change. And it falls part of that political risk, political instability, and civil unrest. Because we have a number of important elections that are coming up over the next 1 to 2 years. We've got elections in Uganda, for example, where the president has been ruling for quite some time. And when there is this resistance to change, then there is the crackdown, and then there's the civil unrest, and then there's the instability, and then change happens almost too quickly. Whereas when you can harness the change that needs to happen in terms of governance structures, then it can be spread out over time. And I think that also falls into the policy certainty that the private sector needs. Is if you can warn the private sector that these changes are coming over a period of time, then it can be manageable. But when it comes out of demand from the population where it needs to happen right now, then I think that's where the challenge comes. So in terms of risk, the resistance to change is I think, Africa's major challenge.
It's difficult to come up with something that nobody else has said yet. But I think from our perspective, there are a couple of key risks that we're sort of keeping our eyes on, right? So one of the greatest risks we're seeing in Southern Africa is sort of managing transitions, or the risk associated with transition. So I think I mentioned before that there's, lots of the legacy mining activity in Southern Africa is downsizing over the next 5 to 12 years. And at the same time, we're increasing investments in infrastructure and renewable energy, or in the energy ecosystem. And on paper, it looks like for like, but in reality, it's not. So we're seeing increasing dissent amongst local communities. That, coupled with the sort of political activity that's currently underway, speaks to a sort of material people risk, or the risk of kind of community instability. At the same time, I think that the risks that are related to the sort of dealing with Africa from a homogenous perspective is far greater and wider than we can even articulate. We're seeing also that there's risks associated, particularly people risks associated with the different categories of investors that we were experiencing. So investors that subscribe to sort of the IFC standards and UN general guiding principles and the Equator principles and all of these things, we can sort of assume that there aren't any human rights abuses associated with that kind of investment. And then you have a whole category of investors that fall outside of those frameworks, that are walking a completely different path. And again, we're experiencing significant levels of increased people-related risks from that perspective.
Thank you.
Yeah, I mean, it's interesting because I'll touch upon a couple of things in one example. So governance and regulation, I mean, it's not harmonized anyway, like the EU, where you have passporting. So we're doing a lot of work in countries looking behind the scenes at carbon market regulations, and that involves passing national acts, as well as regulation, whether it's on the capital markets or related side. We're also doing a lot of work, as we've done in the Seychelles, to advise on virtual asset service provider laws, because, again, the two work quite well because it leads to kind of digitizing some of those commodities that the previous panels spoke about. Now, the number of projects we come across, it doesn't matter whether agri projects, carbon credits projects, where, I mean, projects being bankable is often, an overused term, but there's so much structuring work we have to do to make those projects investable in a form that investors would like to invest into, whether they're institutional investors that you speak about, or even digital investors as well, because even some of the fundamentals aren't always there. And this happens time and time again. So what we're trying to do is, country to country, look at some of the learnings. I mean, there are ease of business issues, and some countries are greater opportunities. I know have greater opportunities than others. I know Kenya wasn't in one of your top 5, huge potential. So we're also looking at potential with countries. Ethiopia is interesting because it doesn't have a stock market, but it's introducing one now as well, yeah, and there's a whole governance framework around that. But whether there's liquidity on that or not, remains to be seen. So I think a lot of the work that we should be doing is around that structuring, harnessing some of the regulation that we have, but also affecting some of that change, affecting it so that we put it into practice.
I want to thank my panelists for this very, very interesting discussion, and I think we can give them a round of applause.